5 states gaining population versus 5 states losing. Real estate impact. Population growth is the single most important factor in real estate. More people means more housing demand, rising prices, and investment opportunities. Fewer people means the opposite: declining demand, stagnant or falling prices, and challenging markets. Today, we're doing a direct head-to-head comparison. 5 states that are gaining population rapidly versus 5 states that are losing people. For each state, we'll show you the exact numbers, explain why people are moving in or out, and most importantly, break down what it means for real estate, whether you're buying, selling, or investing. This isn't theory. These are real population shifts happening right now, and they're creating winners and losers in the real estate market. Let's compare the gainers versus the losers. Part 1. The gainers. Transition. First, let's look at the states winning the population game. Gainer number 1. Florida, the population powerhouse, plus 1.9% annual growth. The numbers. Florida is adding approximately 350,000 to 400,000 people per year through net domestic migration. When you include births and international migration, total population growth is 1.9% annually, among the highest in the nation. Florida's population has grown from about 19 million in 2010 to over 22.6 million today. It's now the third most populous state, and some projections show it could overtake New York for number 3 within a few years. Who's moving in? Retirees, baby boomers from the Northeast, New York, New Jersey, Pennsylvania, Connecticut, Massachusetts. Young professionals, tech workers, finance professionals from California, New York, Illinois. Middle-class families seeking affordability and better weather. Wealthy individuals, high earners escaping state income taxes. International migrants, Latin America, Caribbean connections. Why are they coming? No state income tax. This is massive. A person earning $500,000 in California pays $50,000 plus in state income tax. In Florida, zero. For high earners, this saves tens or hundreds of thousands annually. Weather, year-round warmth, no winter. Beach lifestyle, outdoor recreation 365 days a year. Job growth, strong economy with tech, energy, healthcare, tourism, aerospace, and international business. Quality of life, recreation, dining, entertainment, sports teams, cultural diversity. Business-friendly, low regulations, pro-growth policies. The real estate impact. Prices surged. Tampa median $250,000 2019 to $400,000 plus 2024. Jacksonville $220,000 to $350,000 plus. Orlando $260,000 to $380,000 plus. Miami, already expensive, now $550,000 plus. Tight inventory. Demand far exceeds supply in many markets. Homes sell quickly, often with multiple offers. Rental demand strong. Population growth creates massive rental demand. Investors have piled in. Rents increased 20 to 40% in many markets during peak. New construction booming. Home builders are building aggressively to meet demand. Entire new communities are being developed. Investment opportunity. Single-family rentals in growth suburbs, vacation rentals where allowed, multifamily all have strong fundamentals. The challenges. Insurance crisis. Home insurance costs $10,000 to $20,000 annually, creating affordability issues. Hurricane risk. Regular storms, evacuation stress, potential property damage. Infrastructure strain. Roads, schools, utilities struggling to keep up with growth. Rising costs. Florida is no longer cheap. Prices have caught up to demand. Bottom line, Florida's population boom drives one of the strongest real estate markets in America. Demand remains high despite challenges. Expect continued growth, though at a more moderate pace as costs rise. Gainer number 2, Texas, the job and business magnet, plus 1.6% annual growth. The numbers. Texas adds approximately 470,000 people annually, including births and international migration. Net domestic migration is around 300 to 350,000 per year. Population growth is 1.6% annually, very strong for a state of 30-plus million people. Texas population has grown from 25 million in 2010 to over 30.5 million today. It's the second most populous state and growing faster than California. Who's moving in? Californians, number one source state, tens of thousands annually. Corporate relocations, Tesla, Oracle, HP employees following companies. Young professionals seeking jobs in tech, energy, healthcare. Families, middle-class families seeking affordable housing. Entrepreneurs, business-friendly environment attracts startups. Why are they coming? No state income tax, same as Florida, massive draw for high earners. Job opportunities. Corporate relocations created thousands of jobs. Toyota, Charles Schwab, CBRE, Tesla, Oracle, major companies moved headquarters or operations to Texas. Affordable housing. Texas median is $300,000 to $350,000, though Dallas and Austin suburbs are higher. Much cheaper than California, New York, or coastal cities. Business-friendly. Low regulations, cheap land, pro-business policies. Strong economy. Diverse. Energy, tech, healthcare, manufacturing, finance, agriculture, logistics. The real estate impact. Rapid appreciation in hot markets. Austin, 30 to 40% appreciation during pandemic boom, now correcting. Dallas-Fort Worth, steady 10 to 15% annual gains. San Antonio, 8 to 12% annual appreciation. Houston, more moderate but still growing. Active home building. Texas builds more homes than any other state. Plenty of land and fewer restrictions allow rapid construction. Market cooling in some areas. Austin and Houston have high inventory now, prices moderating or declining slightly in some neighborhoods. Rental market strong. Population growth supports rentals. Cash flow opportunities exist, especially in secondary markets. Investment opportunity. Single-family rentals in growth suburbs, multifamily near job centers, build-to-rent communities. The challenges. Property taxes brutal, 2% effective. On a $400,000 home, that's $8,000 plus annually, significantly impacts cash flow. Some markets oversupplied. Austin and Houston builders may have built too much too fast. Summer heat, extreme temperatures, 100 degrees plus for extended periods. Bottom line, Texas population boom drives strong real estate, though market is more balanced now than during pandemic peak. Property taxes are key consideration for investors. Gainer number 3, North Carolina, the balanced growth winner, plus 1.3% annual growth. The numbers. North Carolina gains approximately 100,000 to 130,000 people annually through net domestic migration. Total population growth is 1.3% annually, consistently strong. Population has grown from 9.5 million in 2010 to over 11.8 million today. Who's moving in? Northeasterners, New York, New Jersey, Pennsylvania, Ohio residents, young professionals. Triple Range Tract attracts tech, pharma, and healthcare workers. Retirees, Mountains, Asheville, and Coast, Wilmington attract retirees. Families, seeking good schools, affordability, quality of life. Reasonable taxes, lower than Northeast, more moderate than no-income tax states. The real estate impact, steady, strong appreciation. Raleigh, 5 to 8% annual appreciation, consistently. Charlotte, 5 to 8% appreciation. Asheville, 8 to 12%, smaller market, high demand. Wilmington, 6 to 10%. Balanced market, not the wild swings of Texas or Florida, steady, sustainable growth. Strong rental demand. Tech workers, healthcare professionals, students, multiple universities create diverse rental demand. Investment opportunity, single-family rentals in growth suburbs, college rentals, mountain vacation rentals. The challenges, competing increasing, more investors discovering North Carolina. Hurricane risk on the coast, factor in insurance costs for coastal properties. Some markets getting expensive. Asheville and parts of Charlotte and Raleigh are no longer cheap. Bottom line, North Carolina offers balanced, sustainable population growth with strong real estate fundamentals, less volatile than Texas or Florida, but reliable appreciation.
This ongoing accretion, often called the cold mode accretion, keeps spirals actively forming stars and maintains their blue colors and spiral structure. The disk is a dynamic, evolving system, not a static structure. Elliptical galaxy formation. The merger path. Elliptical galaxies form primarily through violent gas-pore processes that destroy disks and create spheroidal distributions. The leading formation mechanism for elliptical galaxies is major mergers, collisions between galaxies of comparable mass. When two spiral galaxies collide, their disks are disrupted. Gravitational forces stretch and deform the galaxies. Stars are flung onto chaotic orbits. The organized rotation of the disks is converted into random motions. Here's what happens during a major merger. First, the two galaxies approach and begin their first close passage. Tidal forces, gravitational gradients across each galaxy, stretch both galaxies, pulling out long tidal tails of stars and gas. The galaxies' shapes distort dramatically. After the first passage, the galaxies separate, but they remain gravitationally bound. They swing back toward each other for subsequent passages. Each passage further disrupts the galaxies, scattering stars and gas. Gas in the galaxies experiences different forces than stars. While stars interact only gravitationally, gas can collide. Gas clouds slam together, shocking and heating the gas to millions of degrees. This shock-heated gas radiates energy but can't easily cool to reform a disk. The compression of gas during the merger triggers intense star formation, a starburst. In a brief period, perhaps 100 million years, the merging galaxies might form stars at rates 10 to 100 times higher than normal. This rapidly converts gas into stars. Meanwhile, the galaxies gradually merge. Dynamical friction, gravitational drag from passing stars, causes the galaxies to lose orbital energy. Over hundreds of millions of years, the galaxies spiral together, eventually coalescing into a single remnant. The merger remnant is an elliptical galaxy. The disks have been destroyed. Stars orbit on random trajectories rather than organized circular paths. The system is supported by velocity dispersion, random stellar motions in all directions, rather than rotation. The merger also affects the central black holes. Each progenitor galaxy's central black hole sinks toward the merged galaxy's center. The black holes form a binary, emit gravitational waves, and eventually merge. During this process, gas funneled toward the center feeds the black holes, potentially triggering an active galactic nucleus phase. The intense starburst consumes most of the gas. Supernovae from massive stars heat and expel remaining gas. Feedback from the active galactic nucleus, powerful winds and jets from the accreting black holes, drives out additional gas. The result is a gas-poor system where star formation ceases. The newly formed elliptical galaxy is red, not because all its stars are old, but because it lacks young blue stars. The starburst created many stars that are now aging. Without ongoing star formation to create new blue stars, the galaxy reddens as its population ages. This merger scenario explains many elliptical galaxy properties. Their random stellar orbits reflect the violent formation. Their red colors reflect ceased star formation. Their correlation with dense environments, where mergers are more common, makes sense. And their old stellar populations formed during the merger starburst. Computer simulations of galaxy mergers confirm this picture. When two simulated spiral galaxies collide, the result looks remarkably like observed elliptical galaxies: spheroidal shape, red color, no disk, random stellar motions. The role of environment. Environment plays a crucial role in determining whether galaxies become spirals or ellipticals. In dense environments, galaxy clusters and rich groups, galaxies interact frequently. Close passages and collisions are common. Gas can be stripped from galaxies by ram pressure as they move through hot intracluster gas. Tidal interactions heat and puff up disks. These processes favor elliptical formation or transform spirals into lenticulars or even ellipticals. Galaxy clusters contain mostly ellipticals and lenticulars, with spirals being rare, especially in cluster cores. This morphology-density relation has been known since the 1980s. Denser environments have higher fractions of early-type galaxies, ellipticals and lenticulars, while lower-density environments have higher fractions of late-type galaxies, spirals. The processes driving this relation include galaxy harassment. In dense clusters, galaxies undergo frequent high-speed encounters with other galaxies. Each encounter heats the disk slightly. Cumulatively, these encounters puff up disks, transforming spirals into lenticulars or even ellipticals. Ram pressure stripping: as galaxies move through the hot gas filling galaxy clusters, they experience a headwind. This ram pressure can strip gas from the galaxy, particularly from the outer disk. Without gas, star formation ceases, and the galaxy transforms from a blue spiral to a red lenticular.
The real estate impact. NYC market challenged. Manhattan saw significant price declines during pandemic, especially luxury. Market has recovered somewhat, but inventory remains high. Rental market weakened significantly in 2020-2021, recovered partially, but rents still below peak in some areas. Suburbs mixed. Westchester, Long Island, Hudson Valley saw some increase during pandemic, flight to the suburbs, but long-term trend shows population loss. Upstate struggles. Upstate New York cities, Buffalo, Rochester, Syracuse, facing decades of population decline, property values stagnant or declining. Investment risk. Population loss creates uncertainty, long-term appreciation questionable in many areas. The counterpoint. NYC remains a global city with unmatched culture, jobs, and opportunities. Some neighborhoods and price points remain strong. Bottom line, New York's high taxes and costs drive persistent outflow. Real estate faces headwinds from population loss, especially in suburbs and upstate. Loser number 3, Illinois. Illinois, the property tax exodus. Negative 1.0% net domestic migration loss. The numbers. Illinois loses approximately 100,000 to 120,000 people annually through net domestic migration. Total population has declined from 12.8 million in 2010 to about 12.6 million today, one of only a handful of states to lose population over the decade. Who's leaving? Retirees. Property taxes of $15,000 to $30,000 in suburbs are unsustainable on fixed incomes, moving to Florida, Arizona, Tennessee. Families seeking affordable housing and lower taxes. Young professionals, limited job growth compared to the Sun Belt, moving to Texas, Tennessee, North Carolina. Why they're leaving? Highest property taxes in America. Average over $9,000 annually, but in desirable suburbs, Naperville, Evanston, Oak Park, etc., often $15,000 to $25,000 or more. On a $500,000 home, $20,000 in property taxes equals $1,667 per month, often more than the mortgage payment itself. High income taxes, up to 10.75% combined state and local for high earners in Chicago. Pension crisis. Illinois has one of the worst-funded pension systems in America. Residents worry about future tax increases to cover shortfalls. Limited job growth. Illinois' economy not growing like Sunbelt states. Fewer opportunities, especially for young professionals. Weather. Cold winters with snow and ice. The real estate impact. Slow appreciation. Chicago and suburbs see minimal appreciation. Some areas have declining values. High carrying costs. Property taxes make cash flow extremely difficult for rental investors, hard to pencil out positive cash flow. Long days on market. Homes sit longer due to tax burdens scaring off buyers. Investment challenge. Very difficult to make rental properties cash flow with $15,000 to $25,000 annual property taxes. Most investors avoid Illinois. Some pockets remain strong. Downtown Chicago, Loop, River North, etc., and some top suburbs still attract buyers, but overall trend is negative. Bottom line, Illinois' crushing property tax burden drives relentless population outflow. Real estate faces major headwinds, slow appreciation, difficult investment environment, and shrinking buyer pool. Loser number 4, Louisiana. Louisiana, the hurricane and economic flight, negative 0.9% net domestic migration loss. The numbers. Louisiana loses approximately 30,000 to 40,000 people annually through net domestic migration. Total population has declined from 4.5 million in 2010 to about 4.6 million today, essentially flat or declining. Who's leaving? Young professionals seeking better job opportunities, families after hurricanes, after Katrina, Ida, Laura, many never returned. Students after graduation, graduating from LSU, Tulane, and leaving state for jobs. Why they're leaving? Hurricane risk. Regular devastating storms. Hurricane Katrina displaced hundreds of thousands permanently. Hurricane Ida caused $75 billion in damage. People get tired of evacuations and damage. Limited job opportunities. Louisiana's economy, heavily tied to oil and gas, offers limited opportunities compared to growing states. Insurance costs. Homeowners plus flood insurance costs $5,000 to $8,000 plus annually. Education rankings. Louisiana ranks near the bottom nationally in education. Poverty. High poverty rates affect quality of life. The real estate impact. Low prices but little appreciation. New Orleans median around $280,000, Baton Rouge $240,000. Prices are low but appreciation minimal. Population loss suppresses demand. Fewer buyers means prices can't rise significantly. Rental market challenged. Limited job growth means limited rental demand growth. Investment only for specific strategies. Short-term vacation rentals in New Orleans French Quarter can work. Long-term rentals challenging due to low appreciation. Bottom line, Louisiana's population loss driven by hurricanes and limited economy creates very challenging real estate environment. Low prices but little growth potential. Loser number 5, West Virginia. West Virginia, the declining heartland. Negative 1.2% net domestic migration loss. The numbers. West Virginia loses approximately 15,000 to 20,000 people annually, massive relative to its small population of only 1.8 million. Population decline rate is negative 1.2% annually, one of the fastest declining states in America. Population has declined from 1.85 million in 2010 to about 1.77 million today. Who's leaving? Young people, graduating high school and college, leaving for job opportunities elsewhere. Working-age adults, limited career prospects drive exodus. Births don't replace deaths. Aging population with more deaths than births. Why they're leaving? Limited job opportunities. Coal mining declined dramatically. Few industries have replaced those jobs. Unemployment higher than national average. Economic decline. GDP growth among slowest in the nation. Limited economic activity. Education and healthcare challenges. School and hospital closures in rural areas. Brain drain. Educated young people leave and don't return. Aging population, with limited young people staying. The real estate impact. Very low prices. Median home price around $130,000 to $150,000. You can buy houses for $50,000 to $80,000 in some areas. But little to no appreciation. Population decline means no demand growth. Prices stagnant or declining. Rental market weak. Limited rental demand due to population loss and low wages. Investment risk high. Buying in a declining population state is risky, resale difficult, appreciation unlikely. Only for specific buyers. Remote workers who want ultra-low costs, retirees with pensions, not for investors seeking appreciation. Bottom line, West Virginia's population collapse creates real estate desert, ultra-low prices but no growth potential, only viable for specific buyers, not investors. The direct comparison. Population growth versus decline, the real estate impact. Gainers versus losers, head-to-head. Factor. Gaining states. Plus 1.0% to 1.9% annually. Losing states. Negative 0.9% to negative 1.2% annually. Home price trend.
rising 5 to 12% annually, flat or declining. Days on market, low 20 to 45 days, high 60 plus days. Inventory, tight seller's market, increasing buyer's market. Rental demand, strong and growing, weak or declining. Investment opportunity, high appreciation plus cash flow, low minimal appreciation. Job market, growing diverse opportunities, stagnant or declining. Tax environment, often lower taxes, often higher taxes. Quality of life, improving infrastructure, struggling infrastructure.
The math is simple. More people equals more housing demand equals rising prices. Gainers have buyers competing for limited inventory. Sellers get multiple offers. Prices rise consistently. Investors see appreciation plus rental income. New construction booms to meet demand. Fewer people equals less housing demand equals stagnant or falling prices. Losers have more homes than buyers. Properties sit on market. Sellers must reduce prices. Investors struggle to find appreciation. New construction minimal. The feedback loop. Positive loop. Gainers. People move in, housing demand increases. Prices rise, construction increases. Jobs created in construction, services. More people attracted. Repeat. Negative loop. Losers. People leave. Housing demand decreases. Prices stagnate or fall. Construction stops. Construction jobs lost. More people leave. Repeat. What this means for you. So how should you use this information? For home buyers, if buying in gaining states, act decisively. Don't wait indefinitely hoping for price drops. Population growth drives continued demand. Expect competition, multiple offers, bidding wars common. Get pre-approved, move fast. Your home will likely appreciate. Population growth supports price increases over time. Consider growth suburbs. Core areas may be expensive, but suburbs offer value with appreciation potential. Factor in growth pains. Traffic, construction, infrastructure strain are realities. If buying in losing states, understand appreciation may be limited. Don't count on equity growth. Negotiate hard. Sellers have fewer buyers. You have leverage. Calculate total costs carefully. High taxes like Illinois or New York, or insurance like Louisiana affect affordability. Buy for reasons other than investment. Job, family, lifestyle, not appreciation. Consider resale challenges. Selling later may be difficult. For sellers, if selling in gaining states, you're in a strong position. Demand supports good prices. Price appropriately. Overpricing can cost you in any market, but you have pricing power. Homes sell faster. Expect reasonable timeline. If selling in losing states, be realistic with pricing. Buyers know the market challenges. Expect longer timeline. Homes sit longer in declining markets. Highlight positives. What makes your property or area special? Maybe consider renovations, may be necessary to compete. For investors, gaining states equals better investment. Appreciation potential. Growing population supports rising values. Rental demand. More people need places to live. Multiple exit strategies. Can sell, refinance, or hold long-term. Economic growth. Jobs support tenant incomes. Losing states are challenging investment. Limited appreciation, may never gain significant equity. Weak rental demand, vacancies higher, rents stagnant. Difficult exits, resale challenging, only for specific strategies. Cash flow if you can find it, but appreciation unlikely. Exception, some investors find deep value in declining markets and buy at such low prices that cash flow works, but this requires significant expertise. The future outlook. Will these trends continue? Yes, these patterns will persist. Remote work is permanent. Even with return to office, hybrid and remote work remain common. This gives people location flexibility to move from expensive to affordable states.
tax differences remain. California, New York, and Illinois aren't lowering their taxes. Florida, Texas, and Tennessee aren't adding income taxes. These structural differences will continue driving migration. Affordability gap widening. Expensive states getting more expensive for those who stay. Affordable states remaining relatively affordable. The gap persists. Quality of life factors don't change. Weather, space, lifestyle, these don't change. People seeking warmth, affordability, and space will keep moving south. But some moderation is expected. Gainer states getting more expensive. Florida and Texas prices have significantly risen. This will slow, not stop, migration as affordability advantage shrinks. Infrastructure improvements in losing states. Some states, like New York, California, and Illinois, may invest in improvements to retain residents. Economic cycles. Recessions, job markets, housing affordability cycles will affect migration rates year to year. Climate concerns. Water issues in Arizona, hurricane insurance in Florida, and wildfire risk in California may affect long-term migration patterns. The bottom line, the overall trend, movement from expensive, high-tax states to affordable, low-tax states will continue, but rates may moderate as popular destinations become more expensive. Population growth is the single most important driver of real estate markets. The 5 gaining states, Florida, Texas, North Carolina, South Carolina, and Georgia, are experiencing population booms that create strong housing demand, rising prices, and investment opportunities. The 5 losing states, California, New York, Illinois, Louisiana, and West Virginia, face population decline that suppresses housing demand, limits appreciation, and creates challenging real estate markets. This isn't speculation. This is happening right now based on hard data, and it's reshaping the American real estate landscape. Whether you're buying your first home, relocating for a job, selling property, or building an investment portfolio, understanding these population trends is critical to making smart decisions. Follow the people. They're telling you where the opportunities are. If this comparison gave you valuable insights, please give it a thumbs up and subscribe for more data-driven real estate analysis. Drop a comment. Are you in a gaining state or a losing state? What are you seeing in your market? I'd love to hear from you. Thanks for watching. I'll see you in the next video.